Welcome to another Market Insight Call where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Hi, I'm Aaron Tuttle, Chief Investment Officer at Gatewood Wealth Solutions. Joining me today is Chris Arends, the guy that does pretty much everything here. Chris, it's been a while. It's good to see you.
It's good to be back.
It's been a crazy market. It's been up and down, back up, and it's really hard to tell where we're going, but hopefully at the end of this call, people have some idea, a little bit more clarity on where the market is.
Yeah.
So let's jump right into it. What are we looking at?
I think
here?
it all really starts with the dollar. There's a few charts I pulled here from dollar, volatility index, and bonds. A lot of that has been what's changing the market for equities. And so this is just the dollar index, so against the major other currencies. And it's been almost straight up the entire year. And that line did break. So we drew in that green trend line. And over the last couple of weeks, or last week, there's a big downside break to that trend. And up until this point, you know, the Federal Reserve has really been tightening conditions and really cramping down the money supply faster than other nations and other central banks. So that was really the tailwind for the dollar strength. And now we're seeing a shift in that.
So any idea what's going on with the shift? Do you think it's a Fed pivot? What do you think's going on?
Well, it did come at the same time when the narrative in the market has shifted to Fed pivot, which really came from a lot of inflation numbers, which we'll talk about shortly.
Absolutely. One of the things we were talking about earlier is just, is this the beginning of a bear market? And we'll get into that, but probably not, considering the interest rates on the dollar. The Fed probably is going to continue to move up at least one or two more times. And these are important to us because it really helps us make our changes in asset allocation tilts, whether it be more U.S. domestic, whether it be international. And with this rise being so heavy U.S. for this year has worked out, but last couple of weeks it's been some headwinds.
You know, it does make sense, right? When their currency is going down, the dollar is when the dollar is appreciating and you're valuing these foreign assets, they get valued lower. And the same thing happens for global cash flows that get translated back domestically when the dollar is really strong. So we did see that a lot with tech earnings that do have domestic or international cash flows. They have to translate that back into the dollar, and their growth rates were much slower.
What's this chart telling us? We're looking at the VIX, which is really a measure of volatility on the S&P 500, basically the way to buy insurance on it going upside or downside. And then we have the S&P 500, a very popular and very well followed index.
Right. So the VIX really spikes when there's a demand for insurance. So those usually puts. Right? When the market wants to buy puts to protect yourself, the VIX really spikes. And it doesn't really do the same thing when the market's moving up when people are buying calls. So the VIX goes down, depending when the market's going up. And I've talked to several technicians, and I know the actually creator of our signal strategy kind of made fun of me for this one when I was just saying, hey, when the VIX is getting pretty low, you know, it does tend to be a sell signal. And we drew those out when the VIX was down below 20. Those were actually great sell signals this year. Historically, it doesn't necessarily hold, but at least this year we're seeing when the VIX starts coming down, you know, it probably makes sense to lighten up. The VIX is coming down, but not to those extreme levels that we saw at some of these other market tops.
I would just say this is another oversold, overbought type of indicator where you want to be considering where the VIX is because it may be an indication of a change. And as you pointed out, each time that these have changed this year, it has meant that the S&P was either going to rally or sell off.
And just to frame where we've been the last month. So I like the candles because you see the one-day moves. And really we see at the beginning of November that big FOMC day, right? And that was fully expected, 75 basis point rate increase. The market expected that. But it was the press conference that went on afterwards that really Powell tried to talk down the market. He really is afraid of conditions getting too loose. And he said things like, his closing statement was, we're concerned because inflation's not coming down. That was what he was asked to, what are the chances of a soft landing? And he said, well, they're kind of going away because inflation's not coming down.
Right. And then we get this failed red wave. And really what this is talking about, we're not getting into the politics, is that the market was pricing in a red wave, and they saw that as beneficial for the market And whenever that did not materialize, market prices adjusted. It's minor, but it's a big day movement. But then it's followed right after that with the CPI print that looked very favorable and actually showing that CPI is starting to slow down, which a lot of this is based off of what the Fed is going to do, and if the Fed's going to do something, it's based off of inflation. So that was good news, and we more than recovered what was lost on the previous day for that failed red wave. So then, is inflation deaccelerating? And that's the question I'm posing to you. Do you think it's deaccelerating?
I think it's a little early to throw as big of a party as the market did.
Right.
That was the green candle was big on that chart, but that's also including a gap up. The day was actually over 5% on the S&P 500, and the Nasdaq 100 was up over 7%. So it was a really big move. Probably, I think it's getting a little ahead of itself.
Yeah, and I want to say decelerates again because I kept saying it wrong there. But I absolutely, when we're looking at what is happening, one, the money supply is starting to slow. We'll look at that chart here in a little bit. And that's really, you need that increase in money supply to see inflation expand across all the areas. We are still seeing inflation in the places that people hate seeing it right now, food and energy. But if the money supply isn't expanding, and we have a couple of these different sectors that are going up because of supply issues, you will start to see the other parts of the inflation, the basket begin to decelerate or start to low. And so this is a good sign that we're seeing. I would still say that we're probably not getting back to below 2% inflation rate long term as a trend. I think a good window is 3 to 6, and whenever I think about how much debt the U.S. government has and the need to keep that interest rate low, tells me that it's probably closer to the 6 than the 3. So I do think that there's been a significant paradigm change when it comes to inflation. You want to comment about core inflation?
Yeah, core inflation is probably a lot. Like you said, food prices were going up. Well, that's not in core. Core removes food and energy, and this is often what gets quoted by the Fed. So what people like to track is not just the 1 month change, but a 3-month change, because that's really when you can start saying, well, that there's a change in the trend. And the 3-month core CPI rate is still pretty high. It's at 5.8%. But what the market's also looking at is back in June, that was close to 8. And that's that black line across there. That's just showing, well, are we at least trending downward with our 3-month inflation? And we're trending down, but still pretty elevated.
So then we're looking at national financial conditions. I'm going to let you take this slide. We know we've looked at this before.
We have.
Can you go into a little bit of detail on what we're looking at here?
Yeah, really simple. The trend up is conditions tightening. So that's what the Fed wanted to see. They wanted the pull in conditions. And then when we start seeing it come back down, so at July, there was a little bit of a market rally, conditions loosened up. Then there was that Jackson Hole speech that we remember from Powell, where he tried to stop that. He really intentionally tried to beat up the market to help try to stop inflation. And we saw after that speech, conditions tightened again and went back up. Well, we're getting into conditions loosening back up to a similar spot to where it was when the Fed decided to say, well, we need to actually stop this rally.
And we're talking about market forces that is creating the tight or loose condition. It's not necessarily the Fed policy. Obviously, they have a lot of influence here. But the market is certainly becoming a little bit more favorable on those conditions. Does the Fed know what they're going to do? You have this, you got this snippet from Bloomberg, and it's all over the place.
I just pulled a bunch of headlines which was saying each, really the calendar is kind of our friend right now for the market. There's not a lot to change trend, right? We get another PCE report, another CPI report, and then a Fed meeting in December, where the market's expecting about 50 basis points in increase. So what can really change the market between now and then? Well, momentum, and of course them coming out and talking, because they're all going to give speeches. And this was just pulling the headlines of a bunch of them saying different things, kind of unclear on where they're going. A bunch of people see, well, the economy's slowing, and they want to make sure that remains in focus. And other people say, well, inflation's still at 6%.
Right.
So it's a tough spot to be.
I know that we saw, I think it was Goldman Sachs that came out with 100% probability of a recession in 2023, but then you also have the market taking significant increases here. So it's really hard to tell. And another thing that's really hard to understand is what happened to this FTX. Well, we can't not talk about this in this call.
Well, it looks like it was outright fraud, loaning out customer deposits to another fund that's trading them. So some news came out that that may have been happening, and there was a run on the index or on the exchange, people trying to pull their deposits, and they weren't there, right? They had some major losses and some made-up coins that they made up. Really, the only liquid asset that they had was Robinhood stock, which so far the contagion in the market had been Robinhood went down 30% and other related stocks went down too, but it has recovered since.
So Robinhood stock isn't good Tier 1 capital to bank on?
I don't think so.
This happens whenever there's very loose monetary policy, and through COVID there certainly was, and it often shows up in areas that are very new in the market because people are very optimistic about that, and they probably are a little blinded by their optimism here. Doesn't look like this is something so far that is contagion even within the industry. This does look like it might be a lot of young kids that were really in over their heels and didn't exactly understand what risks they were taking on. I know I saw several videos of their CFO, and it didn't seem like she really understood the market well. It's just a company that grew faster than it could handle.
I don't know how true it is, but you're also probably seeing all these fake balance sheets bouncing around that they were showing investors that look like they're just snippets from an Excel sheet that show the assets of FTX, which turned out not to be true.
Certainly overvalued. But then we got the yield curve, because we did see a surge on that day in yields, but they've really been coming down, especially on the long end of the curve. You want to?
They have, and so the short end of the curve is going to be based on Fed fund rate policy, right? Trying to track the future of rate increases. But the long side of the curve is going to be a lot of market forces, and rates have come down 40, 50 basis points off this inflation rally, which means bonds are rallying, discount rates are coming down, so that helps boost equity prices as well. Our position hadn't really changed, right? We've had a very good year managing bonds relative to the index. Our bonds are still down because we haven't taken as much interest rate risk. We're starting to add a little bit to it. Right? You can get some attractive yields, around 4% on credit risk-free bonds, but the credit bonds are getting another 3 on top of that.
Which means that we're starting to believe that a lot of the interest rate hikes and a lot of the changes in the interest rate to the upside is probably in the rearview mirror. So as we were short for a lot of the year or trying to stay lower, we're beginning to think, well, maybe it makes sense to go a little bit further out on the curve, especially if an inverted yield curve often signals a likeliness of a recession. I'll go back to the Goldman Sachs. There's a lot of optimism in the market right now, probably a little bit overdone, and we might start to see interest rates and yields come down because the recession probabilities in the beginning of the year seem to be fairly high, and an inverted yield curve can contribute to that because banks are going to be less likely to loan long. And there's certainly demand for cash as it's higher. Now, they're not having to pay the 4.6% to depositors, at least not as of yet. But they're certainly not making a lot of 30-year mortgage loans either with rates above 7%. So there's certainly caution here as well. I would say this is another slide where it's causing us to be cautious, and we've talked about this before. Green line is basically measuring the expansion of the money supply or its growth rate over a specific period of time. And it has stabilized, but it's stabilized at a negative growth. And that's basically the Fed policy. They're trying to roll off their balance sheet. They're not decreasing interest rates or increasing interest rates. And though we see good technicals in the market and there's things to be optimistic about, we're a little hesitant to chase those at the moment because there's still a lot of things that the market needs to process that are probably not truly getting priced in. Let's just go right to the PEs here.
Yeah, look, if we look at PEs, so this chart was pulling specific asset classes within the domestic market to say, well, where are we next to our next 12-month earnings and price to earnings ratios? And small cap value is actually at the lowest historical level it's been in a while, and that's consistent with what you'd expect in a slowing economy, right? They're very economically sensitive, but it's also have really strong technicals. So what we've done, a couple of our trades, we're adding a little bit of small cap value, taking off some of the risk in some other spots that was also in a risky asset class, right? We did some from large cap growth to small cap value, very correlated spots. similar expected returns out of both of those, except we have some positive technicals on the small cap value side. But bringing it back to the S&P 500, PE ratios, well, we've had a 10% move in the market, so the PE ratio, without a change in the earnings, so the PE ratio is increasing. Mm-hmm. So the PE ratio on the S&P 500 is close to over 17 now. That's elevated, especially when we look at an environment where, what are your expectations for earnings next year? Well, the market's expecting, 8 to 12, some a little bit higher, right? Those are nominal, so inflation's built into that. But like you said, Goldman's piece, they have zero. They expect zero earnings growth next year. If any scenario comes where earnings come down like that, you're not going to see a 17 to 18 multiple on the S&P. Probably going to be somewhere in the 14 to 16, which is consistent with slowing growth. So I think the market's gotten a little bit ahead of itself with this rally, and we're positioned in a portfolio that's really 90% equity, 10% fixed income on our equity sleeve. And so I hope throughout this we've been able to make the case that we don't want to make that change yet.
Yeah, we don't want to go chasing these. Once again, I said earlier, technicals are positive and constructive, and it makes us want to lean in, but there's also plenty of things here to give us caution, and 90% exposure to the market is probably the correct exposure. We'll lag a little bit, but there's not a big bull case here. Until the Fed pivots, the money supply comes down, some of this economic data starts to improve. I wouldn't say there's a big run up in the S&P 500 that is long and sustained, and certainly not new highs. Mm-hmm. I really struggle with that being the case, especially with interest rates as high as they are. They really have to come down to start justifying PEs at that level again without earnings growth. So we're not chasing this. One of the things that we have done, though, and we started off talking about the dollar, is we've really decreased a lot of our international exposure and emerging exposure over the last year. And the last week, the dollar has weakened in emerging markets, and international markets have really strengthened. And we've, as you mentioned, added to U.S. domestic, but also small cap. So are you comfortable with these changes? What do you think about?
I think they're going to be good long-term changes, right? In the short term, we knew the dollar strength, and we've said it before on these calls, and everyone said it, that it's not sustainable for the dollar just to keep going straight up. So we knew at some point that was going to change, right? It happened pretty quickly, and being underweight international did hurt our relative performance. But in the long run, I think this is strength we're going to want to continue to sell into. We still have some more international positions that we have been trimming down. I think we're going to probably continue to do that.
Right. One of the things that we're looking at for the dollar is this choice between U.S. domestic and versus international, because equity premiums, meaning the return you're going to get on your equity, are pretty much the same across the board. There's going to be some minor adjustments considering the risks that you're taking, but you'll also have a positive or negative for the currency exposure. And when we think about the dollar long term, well, interest rates are higher here. There's more demand for the dollar. It's going to take a big change in events, I believe, for the dollar to be going into a bear market. This looks like just a refresh, a retest, and a sharp decline in the dollar, but I would still favor the dollar over other places, and let's just run through those. Yeah. You have Europe, which has not looked good based on demographics, based on their economy, and as well as just the geopolitics that are going on. We had a missile strike in Poland, and that's a NATO country. And if a NATO country is attacked, which they're having a meeting today, every NATO member is supposed to go. Now, hopefully cooler heads prevail. We can figure out what that is, and there isn't an escalation of conflict. But that certainly doesn't make me want to be long Europe in any of those areas. And then another one is China. Well, they're starting to slow down their zero COVID policy, but they have a slowing demographics as well, probably more so than the numbers indicate. They're losing industry where they've dominated for so long. A lot of it is going to other Asian countries, so a lot of the textiles is moving to Cambodia. But there's not a strong reason that China is going to be as dominant as some of the talking heads talk about. And I guess the one thing that I would be cautioned about is just the House of Saud maybe making an exchange to denominate oil in yuan versus the dollar. I would say that would be a pretty big impact. And I don't know of anyone that is saying that that likeliness is high. But that would be the only thing that would really make me caution on the dollar relative to other currencies. And there's probably still a lot that could be done. And the Biden administration has talked about it a lot, is there's more manufacturing jobs here than a long time. And that is that reshoring that we've talked about for the last couple of years with the problems that we're seeing in supply chains due to the COVID lockdowns, et cetera. Well, we're starting to see manufacturing come back to the U.S., but also into Mexico, where demographics are far more favorable. They have a very young population. So I wouldn't want to be heavy international or heavy emerging markets in this environment, because risk premiums are going to be the same, and I see the dollar as a much better hold than any of those other currencies. Any other changes that we want to talk about?
Clarify the fixed income change rate. Just we're talking about making what we've changed in fixed income is pretty slight.
Yes.
We've added a little. We're not talking about buying 30-year bonds. Those are down 30% on the year. Right. We're talking about making some small changes, just a little bit more in duration.
Yeah, I don't know that a lot of people really know how much of a bear market bonds have been in, especially on that long end, because that 30-year Treasury is something that you consider very stable and to reduce. And we've talked about the need to trim the fixed income exposure, to stay short for several years now. Mm-hmm. Because we believe that the equity-like returns that were received in bonds over the last decade would come back off and you would have equity-like losses. And we're seeing that here. Now hopefully the interest rate is stabilizing and we don't see negative returns like that going forward into the following year. But certainly a very difficult market to be in, whether it's equities or fixed income. We will continue to be diligent. We continue to look at these items on an ongoing basis. Hopefully this is a little bit more clear at the end of this call than when we began, but it is definitely a hard market, and there are not necessarily clear paths the way out. But we do know that being diligent and following our signals and being disciplined is the best way through it. So hopefully you enjoyed this call, and if you liked more of the discussion format than just prepared remarks, please hit that like button. And while you're down there, if you're not subscribed, hit that subscribe button, and always share this with others so that they can be informed and can make good decisions as well. Thank you, and we will see you on our next Market Insight call.